Okay, please, I want you to retake the definition for the matching concept. I didn't get that definition. Well. Thank you.
All right, so let's continue. Let's continue. And so this one, I don't think they can ask you for the purpose of the. I don't think they can ask you for the purpose of the conceptual framework. And even they ask you, I've explained that one already, and the objective too. So we also have the principle of prudence over here. The principles of prudence over here. The prudence is just talking about like whenever you want to make judgments, whenever you want to make judgment or provisions, you should always not be thinking about you getting what? More revenue. You should also be thinking of the what? The likely what? Possible situations. Okay, you sold goods to someone. You can't be thinking that you are going to receive 100% of the amount. So you should be thinking about some of the debts going bad. So you should have a mind that, okay, these things are likely to happen. So the prudence is a caution or is something that is telling us not to overstate our revenue and also not to underestimate our what? Our expenses. So if you sell to someone on credit, you should always not be thinking about the good side. You should make provision for the bad side. So that is about the prudence. Okay. So if you sell to someone on credit, it is likely that you are not going to receive 100% of the amount. So you should be making provisions for what? Bad debt. So it is for the prudence concept that we have provision for bad debt and issues of bad debt. Okay. So we are now anticipating the what, or we are making provision for what? The unknown. We don't know what is going to happen. So we have to make provision for the unknown. That is the prudence. That is the concept of the prudence. So the prudence is the exercise of caution when making judgment under conditions of uncertainty. If you sell to someone on credit, you don't know what is going to happen. You should be thinking about some of the debt going bad. So you should be making provision for bad debt. This helps to ensure that assets and income are not overstated in the financial statement and the liabilities and expenses are not understated. All right. Yeah, Sina Emmanuel, your honors up.
Yes, sir. So if I understand, does it relate to only the sales and purchases or PPEs are also
Yeah, that is why we carry out
the prudence
impairment.
concept?
That is why we carry impairment on what? On PPE.
Oh, okay. Okay.
Yes. So you can't have accident with a car and you'll be thinking that the efficiency of the car will still be the same. No, you can't be making that judgment. So you have to think that the efficiency of the car is going to be reducing. So you have to conduct what? An impairment on that. And that is also about the prudence. Okay. I saw someone has up. Sina Patrick, your hand was up.
I want to ask, with the financial statement, no, is it not based on historical? So with the history and why would the prudence, hello,
Yeah, you are saying that the financial statement is based on what?
historical evidence, like historical events. So with the evidence is being given, why would the prudence concept
But you have made a sales,
be
isn't it? You
used?
have made a sales to the person.
Yeah, and it has been recognized already.
The sales has
Like
been
it's
received,
past,
and
isn't it?
you haven't received any amount from the person, isn't it?
Yeah.
Okay, and there is an information reaching you that this no, you are not going to be just stand up and make provisions on the debt. No, it will be an available information indicating that it is likely that 5% of the amount will not be what received. So maybe at the end of the year, you have recognized that some of the customers are experiencing what? Financial crisis. So it is likely that you're not going to be receiving this amount from these people. All right. So, and the provision that we are making is on the historical facts. It is on the revenue that has already been made. So it's not something like we are bringing future issues to today. No, there's the amount that we are saying that we are not going to be receiving is based on something that has already happened. So still we are within the historical domain. Are you okay?
So like possibly receivables and payables. No?
Is that?
is it possibly to be the receivables and the payables?
You can also have a situation where the payables, you are the one who is going to pay. Okay. So maybe if you can also make provision for discount receipt, but that is not going to be possible because you will be the one to be paying. But so it is always on the receivables. It is always on the receivables. Are we okay?
Yeah, I'm okay.
All right, thank you. So the issue is we have the regulatory framework. We have spoken about what regulatory framework means. We are saying that the regulatory framework is just there to what? To guide people, or is something there to make sure that financial statements are being prepared on true and fair view. People don't use their judgment to prepare the financial statements and put it there, just to make sure the financial statements are being prepared in accordance with what standards or outlines or guidelines given by a regulatory body. That is why we have the regulatory framework or the regulatory system. They are there to ensure that financial statements are being prepared in a manner that is acceptable by a recognized body. Okay, so we have the regulatory framework and we have those that I've spoken about, the interpretation committee, the foundation, all those things are forming the regulatory system. They are there to regulate how accounting profession should be. So they issue the standards. They issue the standards. So why the regulatory framework? The first thing for the regulatory framework to ensure uniformity, to ensure that financial statement, if it is profit or loss, all of them are being prepared using the same guideline or the same principles. So if you have property, plant, and equipment, if it is in Nigeria, they should be using PPE. If it is in Ghana, we should be using PPE. So to ensure uniformity and also to encourage what? International trade. All right. Another one is to ensure that financial accountants comply with what? The regulations or the standard being set by what? A particular regulatory body. So those are the reasons there. They can ask you the reasons for the regulatory framework. Okay. So these are some of the national regulatory framework for financial reporting. So you have the national reporting standard, which is the GAPS. Those days they have been using the GAPS. We also have the national laws, which can be by parliament or the company laws and all those things. We also have the market regulations, which will be by regulations issued by trade and this one, how do they call it? Trade and what ministry?
Industry.
Okay, so they can also issue regulations on how issues should be done in the market and all those things. You can also have the security exchange rules, which are rules set by the Security and Exchange Commission, stock exchange rules and all those things, all right? From that place, then we also have the international reporting standard. Okay, these are the people who are responsible for issuing accounting standard. And they have three main bodies. They have three main bodies, and this is the structure. We have the International Financial Reporting Foundation. These people are responsible to ensure that preparers of financial statement comply with the standards, and also to develop standards in the best interest of the public. So they have numerous responsibilities, and the International Accounting Standard Board is part of the foundation. So the foundation has numerous functions, and one of the functions that they have given to the International Accounting Standard Board is the setting of the accounting standards. So these are the people who publish and set accounting standards. It's one of the responsibilities for the foundation, which has been dedicated to these people. So the foundation has the board, and the board is responsible for issuing standards. Other responsibility that like ensuring compliance, developing the standard in the public interest are performed by the foundation, but the standard setting is done by the International Accounting Standard Board. We also have the International Financial Reporting Standard Advisory Committee. They give advice on when a financial statement should be, a standard should be issued or not. So maybe there's an issue which is of public interest, or there's an issue that is common. You see, companies whenever they want to recruit, they will employ people and pay them. But the companies, maybe companies are no longer doing that. What they are doing right now is that they are doing barter trade with their employees. So instead of me employing someone, I'll just say, okay, I have an IT person, but I need a financial person. One company will also be needing an IT person, and that company will not be needing the financial person. So I will just give the IT person to that person and receive the financial person. So you see that if this practice is not common among the companies, you see that financial accountants will now be using their professional judgment to account for these particular transactions. If this is becoming of public interest or becoming common, then the committee, the advisory committee, will now advise the board on issuing a standard should regulate the treatment of this particular issue. So they give an advice on when an accounting standard should be issued to regulate a particular transaction or item or not. So they are just there to give an advice on when accounting standard should be issued and when accounting standard should not be issued. So issue of public interest, they will advise the board or they will give an advice to the board whether they should issue a standard or not. Let's come to the International Financial Reporting Standard Interpretation Committee. Okay, you see, if the standards are issued, people who, or those who issue the standard, they will understand what they are saying. But people like us will not get the meaning of the standard. So we need people, or we need an interpretation. It's just like if you have any law, there's a regulation to that law explaining what the law is saying. So these people, they are also there to give an interpretation to the standards. So those who are using the standards, these people will be there to interpret what the standard is saying. So they will give the interpretation to the standards. If you come to IAS 16, they are saying that the cost of a PPE, the initial cost will include the purchase price less discounts, any direct costs. The standard just say any direct costs. What are the costs that will form part of the direct costs? So these are the people that will give you the interpretation and then the examples of the costs that they are saying the direct attributable costs. So they are there to give interpretation to the standards. They are there to interpret the standards. So all those plenty things over here, I've given you their functions already. So if you have time, you can look at it. Let's look at how standards are being set. They can also ask you how standards are being set. Okay. First of all, you can see that they have new standards in the system now. We have insurance contracts. Okay. The board they don't just stand up and issue the standard. No. There was an issue which needs a standard should regulate it. So the first thing is that before a standard will be issued, there should be a project. What do we mean by a project? There should be a particular transaction that is common now, and there is no standard regulating it. So we can see that financial accountants or preparers of financial statement are now using their professional judgment to account for that particular transaction. So what do we need to do? We have to ensure that there's a one way of accounting for that particular transaction. So there will be a project, there will be an issue that the advisory committee will now give them advice on whether a standard should be issued to account for that or not. So the project means there's an issue of public concern. There's an issue of public concern, like the one that I've said, that companies are now swapping their employees. Instead of them getting people fresh, they're now swapping, and that is not common. This will be having effect on the financial statements, and there will be a need for the board to issue a standard to regulate that particular transaction. So they will identify the project, they will identify an issue in the system that is of a public domain or public concern. Then the committee will now advise them whether they should issue standard or not. Okay, after the advice has been given to them, what will happen is that there's a need for us to develop a standard. Okay, so the board will now develop and publish what we call discussion paper for public comments. Discussion paper is just something that is issued to the experts people who have knowledge in the standards. There will be an open forum for them to what? To bring their view on what they think should be the right treatment of that particular transaction. So the step 2 will be the board will develop and publish a discussion paper for public comments. So they will now solicit what the ideas from the experts in the industry. So they will receive this particular paper or this particular exercise normally lasts for 90 days or 3 months. After that one, they will receive the suggestions by the experts in the industry. Then they will now look at it, then they will now prepare a draft of what, so they will, not all the views or all the comments will be taken into consideration. So they have to sort it out and pick the relevant ones and now put it as a paper. So this particular draft, we call it exposure drafts. This particular one will also be issued back to the public for their comment on the final one. And this will take like 60 days. So the people will now look at it again. Then they will look at where something should be done, something should not be done. Then the board will still take the exposure draft, look at it again. Then they will now come with a new standard. Then they will now issue a standard. And that particular standard, maybe by approval, will now take what effect. And that is how the standard is being set. We are going to learn this in financial reporting again. And that is basically about the standard setting process. The step 1 is there should be a project. Step 2 is that after the project, which is the advice from the advisory committee or the council, that they should issue a standard, then they will now develop and publish a discussion paper for public comments. This will last for like 90 days. And after that, they will take it, then they will look at it. They will take it and look at it. Okay, they will take it and look at it. Then they will now have a draft. A draft is just like a sample. Let's just say a sample of the standard. Then they will issue it back to the public. They will issue it back to the public, and the public will look at it for some 60 days. Then they will take it back and now come with the full standard and issue the standard. All right. Let's come to issue with corporate governance, company ownership and control. Okay, company ownership and control. Some of you, I don't know whether you have heard about issues of agency problems. Yes, Naima?
Yeah, so just a quick question on the standard and things. I believe before I started this whole accountancy thing, I learned that the ICAG is only limited to Ghana, and therefore, if you have that qualification, you can't actually work outside. And I learned, based on what we've learned, it's being regulated by a single regulatory body. But why is it that case that such qualification cannot be used outside the country?
Okay, the ICA is a country specific. You see, we have global accounting bodies and we also have country specific. So the ICA, the mandate given to is a mandate given to them by the Parliament of Ghana to regulate accounting in Ghana. Are you okay? Okay, so it's not something, it's not a certificate that they have obtained globally to regulate or to regulate accounting globally or over the world. Is their license given to them is limited to Ghana.
Okay.
All right.
Okay, I get it now.
So sometimes too, you can, if you have an ICA, you can operate in UK. Okay, ICA and UK, Institute of Chartered Accountants, England and Wales, they have that relationship, and you can practice with the ICA or the CA certificate of ICA in UK. All right.
Oh, okay.
Okay, but the ICA, their license is not a global one. They are to only regulate accounting in Ghana. That's why.
Okay, so it's their license. Basically, what we learn may be similar, but it's their license which is.
Yeah, exactly.
Okay.
Exactly. Since it's all accounting, you can see that we are going to be having international companies in Ghana. So if we are using the gaps of Ghana, it means that there will be an issue. Those people, they will be having international investors. So it is better that we all use the standard policies for issues for easy comparison. Another issue is for easy comparison. You see that you'll be doing comparison between companies. So if the two companies are using the same accounting policy, there will be an easy comparison also. All right. So if you see CIMA, and they have obtained what? The global license. Yes, please. Yes, please. Okay. And that is the reason why even if you have ICA and you want to go and write CIMA, they will give you some of the exemptions because of the things that we learned in common. Are you okay? All right.
Yes, please.
Okay. Let's come to what we call company ownership and control. Okay. You see that ownership of a company is through what? Purchase of shares. The company is going to issue shares, and if you subscribe to the shares, you become part of the owners of the company. Most of times, the big companies or companies that are big in size, what normally happens is that these shareholders or the owners of the company are not the same people that will be running the company. They are going to now appoint some people, appoint certain individuals who will call directors or management to now manage the organizations of the company. What will happen? What will happen? You see that the objective of the owners is that they want to maximize their return. They want a return on their investments. But the objective of the management is also to have or to be able to take care of their family through their salary that they'll be getting. So they will also be targeting higher remunerations or salary bonuses or a good working conditions. And the shareholders will be thinking about them getting higher return. You will see that these two objectives cannot be achieved at the same time. If you are expecting a higher salary, it means that the shareholders will be getting a lower return. So what do? Or what happened? You see that management will now be doing things at the expense of the shareholders, or they will be taking decisions for their own benefits, and shareholders will be the one to be losing. And this particular difference over here, or this particular difference in objective, brought up an issue that we call agency problem. But this particular one, we are going to look at it under financial management. But what we want to talk about right now is that how do we make sure that management does things in the best interest of the shareholders or in the best interest of the stakeholders or the public? We need to have a system which we call a corporate governance. So since management is concerned with managing the affairs of the company, corporate governance is there to ensure that this function is being performed well, taking into consideration the needs of the stakeholders. So management has to do with controlling the activities of the company or managing the activities or managing the finances of the company. How do we make sure that this management is done in the right sense or in the right direction? We need to bring an issue of corporate governance. So we are going to be looking at an issue of corporate governance, and we look at it. So these are the shareholders, they are the owners. They are now delegate control because they cannot manage the organization themselves. They have other responsibilities that they have to look at. So they will now control, they will delegate control to directors, and the shareholders are the owners and the directors are taking the control. But what happened? Their objectives cannot be the same because these people, they will be looking for higher salary, and these people, they will be looking for higher return. If you are paying higher salary, it means that the salary will be paid out of profit. So less profit will be available for the shareholders. So their two objectives cannot be achieved simultaneously. One has to sacrifice, and one also has to enjoy. But what happened? Management, because of their own interest, and the shareholders are not really with the organization, they don't know what is happening in the organization. Some of the shareholders, they don't even know their managers because they don't have time to go and check anything. So since the directors or management is having access to some vital information, they will capitalize on those information and make bad decisions at the expense of the shareholders. How do we make sure that the affairs of the company are being run in the best manner or in the effective manner to ensure that all the stakeholders are not what disadvantaged. We need to institute what we call the corporate governance. We need to have what we call the corporate governance. Okay, what are people saying about corporate governance? I'm saying that management is about managing the affairs of the company. Corporate governance is about how do we make sure that this management of the affairs of the company are being done in the right direction, are being done well. Okay, so the Kaburi report 1992 provide a useful definition for corporate governance. He is saying that the corporate governance is the system by which companies are directed and controlled. So whatever the management is going to do, they have to make sure that this is done according to the laid down procedures or laid down principles of the organization. You can't go, if it is the policy of the company that you cannot spend more than 20,000 without the approval of the CEO or the board of governors, you cannot go ahead. Why are they doing that? They want to make sure that the activities of the organization or the finances of the organization are being managed well. All right. So they are saying that corporate governance is a system by which companies are directed and controlled. Or an appropriate expansion to this definition might include in the interest of the shareholders and relations to those stakeholders beyond the company boundaries. So I've said that already. The corporate governance is just there to make sure that management of an organization is done taking into consideration the interest of the public or the interest of the stakeholders of the organization. Okay. Let's look at the purpose. So you can read about the purpose. They are all here. What do we need to do again? Let's look at the elements. These are the areas that I can ask you the question on. Let's look at the element of financial statements. If we are talking about element of financial statement, we are talking about if you take a particular financial statement, basically the statement of financial position and also the profit or loss. What are the major items that you'll be seeing? Okay, so we take the statement of financial position first. If we take statement of financial position, we have basically three elements, and these particular three elements can be expanded to have their own branches. Okay, so the first one is assets. Assets. So those of us who have done accounting at the SHS level, we are saying that assets is a resource owned by an entity. What do you mean by a resource owned by an entity? So if you have a company and you bought a car, if the car is not for a personal use, but the car is bought for the use for the company, or is the car is being bought purposely to use in the company, then that particular car becomes a property to the company. It's a property that is being purchased in the name of the company. So that is an asset. Okay, so but the conceptual framework defines an asset as a present economic resources controlled by an entity as a result of what? Past events. What do you mean by control? The asset belongs to the company, and the company is the one that is going to be enjoying the benefit that will be coming from the use of that particular asset. And the company also has the right to direct how the asset to be used or how the property should be used. That is what we call the assets. So if you have a company or if you have a sole proprietorship and you purchase a delivery van, are you purchasing the delivery van for yourself? If you are purchasing the delivery van for the company and you're using the company's money to purchase the delivery van, that delivery van becomes an asset for the company. Okay, so for example, a building that is owned and controlled by a business and that is being used to house its operations and generate revenue will be classified as an asset. So anything that belongs to the company, legally and economically will be classified as an asset. So we look at this one also under financial reporting again, which will be the conceptual framework. But at this level, if they ask you, an asset is a present economic resource controlled by the entity as a result of what? Past events. Some people, they will say from from which future economic benefits are expected to flow to the entity. My brother, if you have the time, you can write all. All right. But any property that belongs to the company or that is being purchased in the name of the company or for the company, it is called assets. All right. Example will be building. Example will be computer. Example will be inventories. Example can be receivables, because the receivables, you are selling an asset or you are giving a property of the company to someone on credit. So that particular person is owing the company. That particular person is now owing the company. So the company resources with the person. So we can say that is an asset. Yeah. Auntie Annabelle, Johan, what's up?
So if that's the case, then what's the difference between an asset and a capital?
Capital is the resource that belongs to the owner of the company.
So, but assets also belongs to the owner of the company. Say,
No, please. No, please.
maybe a sole proprietor.
No, please. If it's a sole proprietor, are you using the asset for your own personal activities? If you start operations by 7 a.m. and you close by 8 p.m., at the end of the day, where would the car be? The car will be at the premises of the company, isn't it?
Yes, please.
Yes. So you are not going to be taking the car to funeral and those kind of things. So basically, the car is for the company. Are you okay?
Yeah. So that's the assets.
That is the assets. But if
So with capital, that means
the capital is just like you are borrowing money to the company, or you are lending money. You are giving the money to the company. It's just like you want to start a business, you don't have money. You can go to somewhere else and take money from someone, isn't it?
yes.
Okay, that money that you have, it will be cash, isn't it? It will be a cash for the company,
Yes.
and it will be somewhere's what it will be a liability too. So the company is having a cash of 5,000 now, and this cash is being financed through what? A loan. So you'll be having both asset and what liability. Okay. But the money that you are putting in the business is for you, which you can decide to go and take it anytime when the business is making profit. You can go and take your money back. When the business is making profit, you can take it back. Are you okay? All right.
Yes, please.
Okay. Okay. All right. So let's come to a liability. A liability is a financial obligation that an entity has to perform to a third party. Or basically, people will say that is the asset's claim against the business. Okay.
So one last question about assets. Sorry.
Okay.
Say, please, with fixed and with assets, non-current assets the same as fixed assets?
Non-current assets. Yes, they are.
Yes, please.
The non-current assets can be tangible or intangible. Okay. That non-current assets they are fixed assets. Basically, they are fixed assets.
Yeah.
Okay.
Okay. Say.
Yes.
So why are they using the term fixed assets? Fixed assets, like, okay, so with non-current assets, it's going maybe those assets can last for some long period of time, right?
Yes, please.
But why are they using fixed assets for it? Fixed, like it cannot move or something.
No. It's not about move. It's the fixed is not about move. Okay. It's not that they are saying fixed. Fixed, that it doesn't mean that it cannot move. Maybe it means that if you buy it, maybe it will be there for some time, and you cannot sell it or you cannot sell it within a year. Okay. So the fixed doesn't mean that it's going to be fixed like that, and it will not be moved. Okay, but the fixed can be of the permanent nature of the asset. It's going to be with the organization for some time. Okay, it is coming there to stay. Not that within some time or within a year we can be able to sell it, or we are going to sell it to any other person. Are we okay?
Yeah.
Okay.
Thank you.
All right. So let's come to a liability. Okay. So if you come to liability, we are talking about someone can say liability is a financial obligation that the entity has to perform to another party. Or someone can say a liability is outsider's claim against a business. What do we mean? Someone's resource is with the organization. Okay. The company is now buying an asset through what? Loan. So the company has taken a loan from someone and they are using the loan to buy an asset. So the company has an asset, but how is this particular asset being financed? We have taken the money from bank to what? To buy the assets. So we have to pay the bank at the end of the day. So that amount that we are going to be paying the bank, or that obligation that we are going to be performing to the bank, is what we call a liability. Okay, so if you buy goods on credit, you now have the goods as a property for the company. But how was the goods being financed? Did you use cash or you bought them on credit? So if you bought them on credit, it means that you are going to pay the person for the credit transaction. And that will now be, you are now having, or someone's resource is with you and you're going to pay the person. And that's what we call a liability. So liability is a present obligation of the entity to transfer an economic resource as a result of past events. For example, it can be an unpaid tax obligation or bank loan is a liability. Or even they can say payables. Someone resource is with the organization. Someone resource is with the organization. Okay, so from this place, although accounting equation is not in the syllabus, it's not here, but we can do something over here. Okay, assuming we have motor vehicle now. Okay, we have motor vehicle, or we bought motor vehicle, 500 cedis. The question is, where did we get the money to buy the motor vehicle? The motor vehicle is for the company. Where did we get the money to buy the motor vehicle? Where did we get the money? Okay, we can say that this motor vehicle was purchased using the money of the what? The owner, which we call the capital or the equity. Okay, so you can say that the motor vehicle, the amount that you are going to use for the motor vehicle will be the capital that you are having. So we can now say that our 500 is equal to 500. We have motor vehicle that is 500 and we have capital that is 500. Motor vehicle is an asset and this is equity or capital. So we can say asset is equal to what? Capital. What do we mean? How did we get the asset? How did we get the asset for the organization? The asset was gotten by using the capital of 500. So the asset is 500 here. All right. Assuming the 500 that we need for the asset, the owner is able to what? To get only 300. It means that we have to fall on someone or a third party for the 200. So it means that the asset over here, which is 500, is being financed to 300 by the owner plus 200 from outsider. So this one is the capital and this is the liability. And that is what we have. Asset is equal to capital plus liability. So if all the resources are being financed by the owner, the accounting equation is equal to asset is equal to capital or equity. But if all the resources are not financed by the owner, then it means that the money is not enough and they have to fall on someone to get what? A support. So the assets, part of it will be financed through capital or equity, part of it will be financed through what? The liability. So the 500 that you have as motor vehicle will be 300 plus what? 200. And that is what we call the accounting equation. Asset is equal to capital plus liability. Auntie Annabelle. All right.
Sorry if I'm actually disturbing.
No.
Okay, so I was looking through some of the exam questions, like question 5.
Yeah.
And most at the interpretation of financial statements and others. So I saw something like shareholders fund. I would just want to ask if in in certain questions, instead of bringing capital, they can maybe bring shareholders fund. Like there's
They will bring equity.
they
will
have
bring-
the same meaning.
no, they will bring equity. Shareholders fund is different from the equity. Okay. If you talk about a shareholders fund, you see, I hope you have prepared balance sheet before, isn't it?
Yeah.
Okay. If you prepare balance sheet, you are going to have capital, then you add what? Profit, isn't it?
Yes, please.
Okay. So if you add the profit to the capital, that is what we call the shareholders fund. That is the money that belongs to the owners of the company. But the capital is called equity. Capital is called equity. So the equity is if you are issuing shares, how much shares were issued? That is what we call the equity. But the shareholders fund is what? The portion of all the things that belongs to what? The shareholders. It will be the money that they are spending in buying the shares. They also have the retained earnings. They also have revaluation surplus and other issues. That is the shareholders fund. So the shareholders fund will include the equity shares, will include the retained earnings, which is the profit, and also revaluation surplus or other reserves. That is the shareholders fund. Okay.
Okay, thank you.
Okay, so don't declare the shareholders fund as capital, no. All right. Okay. So we are saying a liability, anyone's resource. If my 10 cedi is with you, that particular 10 cedi is an obligation that you have to perform to me. You have to pay the 10 cedi to me. So in that case, the 10 cedi that you are owing me is a liability. It's an amount that you have to pay to me. So that is a liability. Okay. So and any property in an organization that belongs to someone else, that is not for organization, is called liability. Let's just put it like that. Let's just put it like that. Okay, let's come to equity. Equity. We know how we find equity. Equity is just the difference between asset and what? The total liabilities. Total assets minus total liabilities. So the conceptual framework defines equity as the residual value in the asset of the company after deducting all of its liabilities. So they are just using what? The accounting equation to define this, which is assets minus what? Liabilities will give us equity. So they are just defining equity from the what? The accounting equation perspective. Are we okay? So that is equity. That is equity. Let's come to income. I want us to let me check what we have again, so that maybe we can finish it next week. And let me see what we have. Okay, we have this one. So seniors, we have the qualitative characteristics and also the examples of this one. Okay. We're supposed to close at 8:30, but I'm not sure we can be able to finish all of this. This is an examinable area. We need to take our time to look at it very well. So seniors, I would like us to end it over here so that next week we continue, and I will drop additional note on the chapter 2. Okay, then we continue with we finish with this one, then we continue with the calculation. All right. So please, do you have any question before we call it a night? Please, do you have any question?
Not really.
Okay, so everything is clear.
Yes, please.
Okay. So these are some of the past questions, the tutorial questions. You can try to get more to have issues. No one knows. They can decide to repeat some of them. So this particular topic is 20 marks, and you have to really be on top of issues if you want to pass the paper. All right. So seniors, thank you for coming, and I will see you guys.